Alrighty, in Chapter 20 we're going to be talking about money, financial institutions, and the Federal Reserve. I know, more powerfully interesting subjects. Alright, one of the things that your text defines and something that needs to be understood in this context is the idea of money. Money is generally defined in this context as anything people generally accept as payment for goods or services. And this leads us to the idea of barter, which is a direct trading of goods or services for other goods or services. Obviously, we're looking at the fact that this is not always paper currency, nor coin. Standards for a useful form of money, of course, as defined by your text: portability, divisibility, stability, durability, and uniqueness. I would say that our paper currency qualifies on all fronts. Now, one of the things that we talk about when we talk about business on a national and global scale is the idea of the money supply. Now, the money supply is the amount of money the Federal Reserve makes available for people through the Federal Reserve and other banking systems. The money supply is referred to, and this is important, M1. That is all money that can be accessed quickly. Coins, paper money, traveler's checks, etc. Things at that level. M2 is M1 plus the money that may take a little time to obtain. Money in savings accounts, mutual funds, other financial instruments such as this. M3 is M2 plus big deposits like institutional money, market funds. In other words, M3 is everything. Now, how long does typically paper money last? You're looking at anywhere from 21 months to 89 months as shown by the graph. The low end being dollar bills, the high end being $100 bills. And of course, the reasoning behind this is the fact that dollar bills are circulated in a much more involved and rapid fashion than $100 bills are. Now, as far as exchanging money globally, this is where we look into the concept only just on the surface, if you will, concerning an intro class in business to the idea of the value of the dollar. Falling dollar value simply means that the amount of goods and services you can buy with a dollar decreases, and in opposition, a rising dollar value obviously means that you can purchase more goods and services with a dollar. Now, what affects this? How is this affected? Well, it can be a very complicated process, but it all comes down to one basic fact. The dollar rises or falls on the position of the U.S. economy relative to all other global economies. Now, the impact of the falling dollar? Quite simply, overseas demand for U.S. products rise. It's then cheaper for them to purchase. And a favorable exchange rate for U.S. companies increases profits in foreign markets. So when the exchange rate is favorable in that fashion, businesses that do global shipping, that do global business, in fact can increase profits in foreign markets. And U.S. tourism tends to increase because hotels, resorts, theme parks, and retailers that serve these types of international travelers are able to, in fact, give those international travelers more bang for their buck, if you will. Now, what we're talking about when we're talking about money in the United States is basically the Federal Reserve System. And there are 5 major parts, as your textbook points out. First is the Board of Governors. That is presided over by the chair of the Fed. Example would be the current Fed chair, which is Ben Bernanke, although they are looking to replace Mr. Bernanke as he is retiring. Those talks, negotiations, and ratification procedures, if you will, are going on presently. Number 2 is the Federal Open Market Committee. That is the committee directly under the Board of Governors that oversees the ideas and operations of the open market itself with regards to the Fed. Next to the 12 Federal Reserve banks, they are located in strategic places throughout the United States. To my knowledge, as I remember, one is located in Chicago. There are 3 advisory councils that work with the Fed and their committees, their various boards and committees, in helping them shape monetary policy in the United States. And then there are, of course, the member banks of the system. Anytime you see a Federal Reserve Bank, that is a member of that system. Anytime you see that denotation. Now, the graph on the following slide illustrates the 12 Federal Reserve District banks. And as you can see, Chicago, St. Louis, Kansas City, Minneapolis, so on. Now, when we talk about the Fed managing the money supply, we're looking at 3 basic tools. And please don't be so worried about getting in the weeds about this, but make sure that you understand what this means. First is the reserve requirement. Now that's a percentage of commercial banks' checking and savings accounts that they must keep in the bank or in non-interest bearing deposits at the local Federal Reserve District Bank. In other words, it's the amount of money on hand that they must keep, their reserve requirement, and that is set by the Fed. Obviously, when the reserve requirement is lessened, that means that there's more money for that particular bank to utilize to loan out through various forms and fashions in order for that bank to make money. So the lower the reserve requirement, the more profit that individual bank stands to make. Next, open up market operations. This is quite simply the buying and selling of government bonds and everything that is involved within that procedure. And again, won't go far into the weeds on this one because quite honestly we could take up probably at least a fourth of the semester speaking about this alone. Finally is the discount rate. Now that is the interest rate that the Fed charges for loans to member banks. Where you may have come across this idea of the discount rate is sometimes people look at it almost as the prime rate. And you may see negotiations, you may see terms for loans for very favorable customers at prime +1 or discount +1. This simply means that it's typically 1 percentage point above the discount rate or the prime rate, however it is listed. Now, the following slide speaks to the check clearing process through the Federal Reserve. Don't be too overly concerned about this. This is all mostly done electronically these days, and it is done at such a rapid pace that, quite honestly, the computers control pretty much the entire operation. Now, when we were talking about the idea of the Federal Reserve System, this has always been in place. In fact, in the history of the United States, it's been in place a relatively short time. There was a cash shortage, as you can see, in 1907 that led to the creation of the Federal Reserve System. Under that act of 1913, which even back then, folks, like today, it seems to take a long time to argue out the details on matters such as this. But under the Federal Reserve Act of 1913, all federally chartered banks had to join the Federal Reserve. In other words, if you had a federal charter, you must be a member of the Federal Reserve. Now, one might ask, then why be a federally chartered bank? Simply because the appearance of this, people looked at these banks with a more favorable opinion and more trust than banks that were not federally chartered. Have there been bank failures? Absolutely. As you can see by the next chart, Washington Mutual, 2008, $307 billion in assets. That is the largest one listed in this graph. Down to Colonial Bank in 2009, $25 billion. One that you might recognize is the American Savings and Loan Association. Back in the savings and loan scandal, that was back in 1988, and it was $45 billion. Now, when we're talking about the reserve and the banking system itself, what are we talking about with regards to the banking system? Well, first of all, we're talking about commercial banks. We're also talking about, however, savings and loan associations, credit unions, and non-banks. There are entities that are not banks that are part of this system. Commercial bank, first and foremost, is a profit-seeking organization. And that's important, folks. A profit-seeking organization that receives deposits from individuals and corporations in the form of checking and savings accounts and uses those funds to make loans. This goes back to the idea of the reserve requirement. The lower the reserve requirement for commercial banks, Federal Reserve member commercial banks, the more money they have available to loan out, the more money they can make from the interest payments on the money that they loan out. Now, typical commercial bank services, demand deposit, it's simply a technical name for your checking account. Money is available on demand. A time deposit or a savings account, which a bank can require a prior notice before you make a withdrawal. They typically won't on small withdrawals, but in large withdrawals of customers with a sizable amount of assets or a sizable amount of money in these types of accounts, they can in fact require that. And certificate of deposit, simply a savings account that earns interest to be delivered on the certificate's maturity date. For example, if it's a 10-year CD, a particular amount of money with a particular rate of interest will be available on that date. Now, as you can see, we won't go into this in large detail, but banking has very much become an electronic game these days, and I use the word game perhaps slightly facetiously. However, many millions of transactions happen every day that are basically controlled by the flow of computerization. The days of having human beings touch, if you will, everything along the process are far over. Now, what's the difference between a bank and a savings and loan association? Savings and Loan Association is an institution that accepts both savings and checking deposits and provides home mortgage loans. Banks that are not savings and loan associations do not necessarily provide all three services. Credit unions, are basically nonprofit, member-owned institutions or cooperatives, if you will, that offer the full variety of banking services to their members. They typically offer checking, although it's quite often called draft or a draft instead of a check. They offer savings. They offer loans. They can offer, the complete range of services. Well, the one good thing is, as you will notice on this slide, because they are nonprofits, credit unions enjoy an exemption from federal income taxes. So they can afford to perform things at a somewhat discounted rate from a regular bank for this very reason. Now, there are also, as we referred to earlier, non-banks, and these are financial institutions that accept no deposits, but they offer many of the services of regular banks. For example, life insurance companies, you can borrow against life insurance policies. Pension funds, you can sometimes borrow against pension funds depending upon the way it's set up. You can also, gain access to your money early, although typically if this is available to you, a very stiff penalty may have to be paid. And then, of course, brokerage firms. They can utilize some of the ideas or services of a bank, when they are in fact not banks. Now, why do many people do online banking these days? Well, first and foremost, because it's much easier. When it's 10 below outside, nobody wants to get in a cold vehicle to drive down to the bank to take care of business. Much better to sit in front of your fire with your laptop stretched out before you and handle anything that you need to handle concerning your banking. However, of course, many banks offer services above and beyond regular banking services for online customers. For example, some of them offer free identity theft protection. Many of them offer free credit score monitoring. Many of them will allow you to avail yourself of personal financial management. Some have message services. Some even have weblogs or blogs. It simply matters as to what works for their customers and what helps them attract customers. Let's talk a little bit about protecting the money of depositors. First and foremost, many of you have probably heard of the idea of the FDIC, or the Federal Deposit Insurance Corporation. It's an independent agency of the U.S. government that insures bank deposits up to $250,000. Now, this will mean $250,000 for each separate account. So if a husband and wife each had an account in a particular bank, in effect, $500,000 of deposits would be insured. Next is the Savings Association Insurance Fund. This operates in a similar fashion to the FDIC, but it simply insures holders of accounts in savings and loan associations. Insures their money much the same as the FDIC does for regular banks. And then finally there is the NCUA, which is the National Credit Union Administration, which provides up to $250,000 coverage per individual depositor per institution. Again, much the same as the FDIC. Now, of course, there have been many types of technological advancements that have happened in banking. Perhaps two of the most important are EFTs, or electronic fund transfers. And Simply send messages about a transaction from one computer to another so that funds are technically transferred. Now, does the amount of money, the physical amount of money, leave one bank and go to another bank or to pay for a service? It depends upon how it's set up. It may never physically leave the bank. Second, of course, is a debit card, which again serves the same function as a check, withdraws money from your checking account. But there is not the idea of the physical exchange of handing over a check to another individual. Now, there are also what's known as smart cards. They're a combination of credit cards, debit cards, phone cards, driver's licenses, and can be much more. Honestly, I've never seen one of these in action, so my knowledge of these is somewhat limited. Now, transactions that you will typically make if involved with other countries is you may in fact have what's known as a letter of credit, and this is simply a promise by a bank to pay a seller a given amount if certain conditions are met. I do apologize for the yawning. Second is a banker's acceptance. This is simply, again, a promise that a bank will pay some specified amount at a particular time. These are just two types of financial transactions in other countries. Now, a couple of leading institutions that are looked at concerning international banking. First is the World Bank. Simply lends most of its money to less developed nations to improve their lot. Quite honestly, in an effort to help third world countries rise from that low status level. Some, perhaps many of you, may have heard of the work that Bono has done throughout the world trying to get a lot of this debt reduced, if not, totally excused. Next is an organization known as the International Monetary Fund, or the IMF. Simply an idea of fostering cooperation within monetary policies between the signatory members of the Monetary Fund, which right now we're looking at around 185 or so countries that are part of the IMF. Now, your text talks about issues facing the World Bank and the IMF. Folks, this typically comes down to the idea of when Japan's economy burps, Europe may be left with a bad taste in their mouth. It simply means that most everything of any size or portent whatsoever in a country will have some type of economic effect in other countries in the world. Things are simply that interconnected these days. As we've talked about all along, this is truly a global economy. Now, that is the end of chapter 20. And of course, as always, if you have any questions or concerns, please contact me on my cell or through my email.